Understanding the $100,000 annual limit for incentive stock option, IRS rule explain. What does the annual limitation of $100,000 for incentive stock option mean?
According to the IRS website, there is a $100,000 annual limitations on the value of an employee's ISOs that may become exercisable for the first year during any calendar year. See IRC 422D. This limit is determined based on the FMV of the stock at the time the option is granted and not at the time the option vests, to the extent in which a ISO is exercisable for the first time. First day the FMV exceed $100,000. The excess amount over $100,000 is treated as non-statutory option, subject to all employment tax rules governing those options. At the time of exercise, this results in ordinary income to the employee and a wage deduction to the employer. See Treasury Regulation 1.422-4 for rules related to the $100,000 rule. See IRC 422C5 for the special rules for a 10% owner.
Background concept. ISO, incentive stock option. A type of stock option that has specific tax advantages if certain conditions are met. One key rule is the $100,000 limit. No more than $100,000 worth of ISOs based on their value at the time they were granted can be exercisable in a single calendar year. Exercisable. When we are allowed to purchase the shares at the option's set price, the exercise price. NQSO, non-qualified stock option. A type of stock options without the special tax benefit of ISO. If a ISO loses its status, it becomes a NQSO. Cancellation of ISO. If an ISO grant is canceled, the treatment under the $100,000 rules depends on its vesting status at the time of cancellation. Underwater ISOs are stock options where the exercise price, the price at which the holder can buy the stock, is higher than the current market price of the company stock. Underwater ISOs are generally a result of a declining stock performance and can create challenges for both employees and companies trying to maintain motivations and alignment. We learn by doing, so let's look at some examples.
Example 1. Grant 40,000 shares. Exercise price is $10. The fair market value of the stock at the time the option is granted is $10. 25% of the option vests each year on the grant date. Calculation. 40,000 shares divided by 4 years vest 25% annually equals 10,000 shares vest per year. 10,000 shares times $10 fair market value of the stock at the time the option is granted, not exercise price, equal $100,000. Year 1, 10,000 times $10 equal $100,000. Remain ISO status. Year 2, 10,000 times $10 equal $100,000. Remain ISO status. Year 3, 10,000 times $10 equal $100,000. Remain ISO status. Year 4, 10,000 times $10 equal $100,000. Remain ISO status. Example 2. Grant 40,000 shares. Exercise price is $12. The fair market value of the stock at the time the option is granted is $10. 25% of the option vests each year on the grant date. Calculation. 40,000 shares divided by 4 years vest 25% annually equal 10,000 shares vest per year. 10,000 shares times $10 fair market value of the stock at the time the option is granted, not exercise price, equal $100,000 per year. Year 1, 10,000 times $10 equal $100,000. Remain ISO status. Year 2, 10,000 times $10 equal $100,000. Remain ISO status. Year 3, 10,000 times $10 equal $100,000. Remain ISO status. Year 4, 10,000 times $10 equal $100,000. Remain ISO status. Example 3. The $100,000 limit applies to the total value of ISOs that vest in a single year. For multiple ISO grants, the annual limit is calculated by adding them up in the order they were granted, and any amount over this limit is automatically treated as NQSO. See IRS Section 1.422 for more details. Grant 40,000 shares. Exercise price is $12. The fair market value of the stock at the time the option is granted is $10. 25% of the option vests each year on the grant date. Granted an additional 1,000 shares in year 2 with exercise price $12. Fair market value $10. 25% of the additional shares vest each year on the grant date. Calculation. Original grant 40,000 shares. 40,000 shares divided by 4 years vest 25% annually equal 10,000 shares vest per year. 10,000 shares times $10 equal $100,000 per year. Additional grant 1,000 shares in year 2. 1,000 shares divided by 4 years vest 25% annually equal 250 shares vest per year. 250 shares times $10 equals $2,500 per year. Year 1. Original grant of $10,000 times $10 equals $100,000. $100,000 remain ISO status. Year 2. Original grant $10,000 times $10 equal $100,000 plus additional grant of $250 times $10 equals $2,500 equal $100,000 remain ISO status and $2,500 becomes NQSO. Year 3. Original grant of $10,000 times $10 equal $100,000 plus additional grant of $250 times $10 equal $2,500 equal $100,000 remain ISO status and $2,500 becomes NQSO. Year 3. Original grant of $10,000 times $10 equal $100,000 plus additional grant of $250 times $10 equal $2,500 equal $100,000 remain ISO status and $2,500 becomes NQSO. Year 4. Original grant of $10,000 times $10 equal $100,000 plus additional grant of $250 times $10 equal $2,500 equal $100,000 remain ISO status and $2,500 becomes NQSO. Year 5. Additional grant of $250 times $10 equal $2,500 remain ISO status. Our company should differentiate between ISOs and NQSO when grant exceeds the $100,000 limitation. If no designation is made, it is assumed that we exercise the ISOs before the NQSO. Example 4. Focus on the year the option vests because they become exercisable rather than the year they are exercised. Continuing from example 2, we exercise all of our 40,000 ISOs in year 4. All 40,000 ISOs are ISO because only $100,000 worth of ISOs are vested in year 4. The remaining ISOs are vested in year 1, year 2, and year 3. Year 1. 10,000 times $10 equal $100,000. Remain ISO status. ISO is not exercised. Year 2. 10,000 times $10 equal $100,000. Remain ISO status. ISO is not exercised. Year 3. 10,000 times $10 equal $100,000. Remain ISO status. ISO is not exercised. Year 4. 10,000 times $10 equal $100,000. Remain ISO status. Exercise all 40,000 ISOs and all 40,000 ISOs will still be ISOs. Treatment of modification, cancellation, and disposition. Section 1.422-4B5II of the 2023 proposed regulations provide that if the option is not canceled, modified, or transferred prior to the year in which it is first become exercisable, it is treated as outstanding until the end of the year in which it is first become exercisable. Let's break down the regulation into 4 parts. 1. Disqualification before vesting year. If ISOs are modified, transferred, or canceled, which disqualifies them from ISO status before the year they vest and can first be exercised, they are excluded from the $100,000 limit calculation. Essentially, they don't count towards the limit since they were disqualified before becoming exercisable. 2. Disqualification after vesting year. If disqualification happens after the option vests and are first exercisable, the ISOs are considered outstanding and will count towards the $100,000 limit for the year they become exercisable. This rule applies even if they are canceled later in the same year. 3. Prior IRS rules. Before the final regulation were issued, exercisable ISOs that were canceled during the year didn't count against the $100,000 limit for the full year. This is no longer the case. 4. Disqualifying disposition. Selling the shares in a way that disqualifies the ISOs, cashless exercise, doesn't affect how they count towards the $100,000 limit. They are still included in the calculation for the year they vest and become exercisable. In short, the timing of disqualification before or after the year of vesting determines whether ISOs are included in the $100,000 limit. Disqualifying disposition don't remove them from the calculation. For more details on this regulation, check out the IRS websites and the Code of Federal Regulation. Below is the direct quote from the Code of Federal Regulation. A option or portion thereof is disregarded if, prior to the calendar year during which it will otherwise have become exercisable for the first time, the option or portion thereof is modified and thereafter ceases to be an incentive stock option described in section sign 1.422-2, is canceled or it is transferred in violation of section sign 1.421-1B2. If an option or portion thereof is modified, canceled, or transferred at any other time, Such option or portion thereof is treated as outstanding according to its original terms until the end of the calendar year during which it will otherwise have become exercisable for the first time. A disqualifying disposition has no effect on the determinations of whether an option exceeds the $100,000 limitation. Grant order and acceleration rules. The Electronic Code of Federal Regulation also teaches us that options are taken into account in the order in which they are granted. With multiple incentive stock options, ISOs become exercisable in the same year due to acceleration. The most recent grant options are evaluated first, working backward, to determine which exceed the $100,000 limit. If the most recent grant options have already been exercised, they retain their ISO status but still count towards the $100,000 limit for that year. Example 5. It seems that some awards, often at private companies, might include a provision allowing employees to exercise ISOs immediately upon grant. These are sometimes referred to as early exercise stock option. From what I understand, they could be considered exercisable right away, even if the resulting shares are unvested. It is possible that the $100,000 limit applies to the full value of the award at the time of the grant. If there are other outstanding ISOs grant exceeding the limitation might lead to some of these options being treated as NQSO. However, it is always a good idea to consult a tax professional for clarifications on these matters. We can read this document to learn more. Let's use example 2 and we will add on the ability to exercise the ISOs immediately upon grant. Grant 40,000 shares. Exercise price is $12. The fair market value of the stock at the time the option is granted is $10. 25% of the option vests each year on the grant date. We have the ability to exercise ISOs immediately upon grant. Scenario breakdown. Grant 40,000 shares. The total potential value of the ISOs grant is 40,000 shares times $10 FMV at grant equals $400,000. 2. Exercise price is $12. The exercise price is above the fair market value FMV at the time of the grant. There is no immediate bargaining element because the exercise price is higher than the FMV. 3. 25% vesting per year. Normally, 10,000 shares vest each year, and the $100,000 limit would apply to those shares exercisable in each year. However, with the early exercise provision, the entire grant, 40,000 shares, could be treated as exercisable immediately upon grant. $100,000 ISOs limitation calculation. The $100,000 limit is based on the FMV at grant, $10 per share, not the exercise price, $12 per share. The maximum number of shares that can qualify as ISO is calculated as follows. Maximum ISO shares equal $100,000 divided by FMV at grant of $10 per share equal 10,000 shares. 10,000 shares qualify as ISOs under the $100,000 limit for the year the options are exercisable. The remaining 30,000 shares, 40,000 total ISOs minus 10,000 ISOs, will convert to non-qualified stock option, NQSO. Tax implication. Number 1. ISO shares, 10,000 shares. These retain ISO status and may qualify for favorable tax treatment if the required holding periods are met. 2 years from grant and 1 year from exercise. Number 2. NQSO shares, 30,000 shares. These are treated as non-qualified stock option, NQSO. The bargaining element difference between the FMV at exercise and exercise price will be taxable as earning income at the time of exercise. Number 3. Early exercise consideration. With the early exercise provision, unvested shares will likely be subject to a substantial risk of forfeiture. Depending on the term, a Section 83B election may allow the taxpayer to report income as the time of exercise based on the FMV at $10 per share. Summary of impact. ISOs treatment. 10,000 shares qualify as ISOs under the $100,000 limit. NQSO treatment. 30,000 shares are treated as NQSOs and may trigger ordinary income tax on exercise. Vesting and risk of forfeiture. Early exercise shares involve tax consideration based on vesting schedule.
Now we are diving deep into the $100,000 annual limit for incentive stock option. Fascinating, isn't it?
Example 6. Acceleration of vesting could trigger the annual limitations of $100,000 limit for incentive stock option. Normally, ISO vests become exercisable over time, spreading out their value across multiple years. If an event like a merger, acquisitions, or job terminations agreement accelerates the vesting, more of the ISO's value might become exercisable in a single calendar year. If this exceeds the $100,000 limit, any excess value of those ISOs loses its tax advantage status and convert to NQSO, but the options themselves aren't forfeited. The $100,000 limit is calculated based on the value of the options at the time they were granted, not their value at the time of acceleration. We receive ISO with a grant value of $200,000, vesting evenly over 4 years, $50,000 per year. If an event accelerates vesting so that $200,000 become exercisable in 1 year, this exceeds the $100,000 limit. The $100,000 remain eligible for ISO status and excess $100,000 loses ISO status and becomes NQSO. Example 7. When a company cancels incentive stock option, their treatment under the $100,000 annual limit depends on whether they have vest. Unvest ISO. If canceled before the calendar year they become exercisable, they no longer count against the $100,000 limit. This allowed the company to issue new ISOs or adjust grant without exceeding the limit. Vested ISOs. If already vested and exercisable when canceled, they still count against the $100,000 limit for the year. Replacement ISOs are limited by this cap. Tax implication. Replacement ISOs are treated as new grant with a fresh timeline for favorable tax treatment, 2 years from grant and 1 year from exercise. In 2020, we were granted ISOs with an aggregate exercise price of $70,000, vesting on January 1st, 2024. In 2021, we were granted another set of ISOs with an aggregate exercise price of $70,000, also vesting on January 1st, 2024. The 2021 ISOs are underwater. Stock price is below the exercise price, so the company canceled them in 2023. Result: the $30,000 from 2021 no longer count against the $100,000 limit because they were canceled before 2024, the year they would have first become exercisable. This allowed the company to re-grant $30,000 worth of ISO without exceeding the cap for the year. If these options have already vested, canceled in 2024, they will still count against the $100,000 limit for that year. Example 8. The 10% ownership rule for a standard stock option stipulates that if an employee owns more than 10% of the total combined voting power of all classes of stock of their employer corporation, certain conditions must be met for the stock options to qualify as ISOs. Exercise price. The option price must be at least 110% of the fair market value of the stock at the time the option is granted. Option term. The option must be exercisable within 5 years from the date of grant. Exercise price. The exercise price must be at least 110% of the fair market value of the stock on the grant date. If the FMV is $100 per share on the date of grant, your exercise price must be $110 per share or higher. If the exercise price has been set below $110 per share, the option will fail the 10% ownership rule and loses ISO's tax treatment, becoming non-qualified stock option, NQSO instead. Exercise term. The option must be exercisable within 5 years of the grant date, instead of the standard 10 years. If we miss this deadline, the option expires.
Limit to the number or value of ISO granted to employees. While there is no explicit limit on the number or value of ISO that can be granted, the $100,000 rule stipulates that the aggregate fair market value of stock options that can become exercisable for the first time in any calendar year cannot exceed $100,000. Any amount exceeding this is treated as a non-qualified stock option for tax purposes. Normally, the plan is approved by the company board of directors and shareholder. ISO can only be granted to employees, not to consultant or outside directors. Please note that this material is for educational use only. Tax law are written in pencil, they can always be rewritten. Tax law are complex. There are exceptions to the rules, and it is constantly changing, so don't do it alone. Be sure to talk to a qualified professional before making an informed decision. I hope you enjoyed this video and thank you for watching. Until next time, this is Tan, your trusted advisor.